Good afternoon, everybody. Welcome to our webinar this month. July is National Savings Month, which is a time for us to focus on improving savings habits in South Africa. So many people confuse the two terms, saving and investing, and both are fundamental to financial security, but it's important to also understand the difference, and then hence this webinar. You can see the topic there, how to save and invest for the future. So on the most basic level, saving involves putting money aside to use in the near future, call it short term, while investing involves putting money into investments, obviously with the goal to grow, obviously over the longer term. So we put our money investments into things like unit trust, property, shares, etc. So the biggest difference, and this is what I'm going to spend a lot of my time on today, is between the two is the level of risk taken. So while saving typically results in lower returns with virtually no risk, investing affords an opportunity to earn returns, but there's obviously associated a level of risk with that. So good afternoon, everybody. My name is Sean van den Berg. I'm an investment specialist here at PSG Wealth. My goal today is to discuss some important criteria to consider when saving and investing. So just to kick it off quickly, here's my agenda. Oops, pushed the wrong button. Here's my little agenda for today. The three topics as always: why should I invest, save and invest? What are the best savings investment vehicles? And how do you start saving and investing? So just to give you some context, over the years, financial experts have been calling South Africans to save for the proverbial rainy day. Contrary to widely held perceptions, however, most South Africans want to save, and also they understand the importance of doing so. But the large majority find it difficult to save because they find most formal savings offerings overly complex and intimidating. And they also don't understand how the savings, a typical savings account can help them grow their money. So obviously that's, just as I give you some context, what we're going to be discussing today. It's also interesting to note that the younger generation is increasingly turning towards new ways of growing their money, such as share and forex trading and cryptocurrency, because in general, they have a greater appetite for risk. This is an indication that the younger investors look for more aggressive growth because they want to build wealth fast, which is obviously not necessarily a bad thing. So we discussed this in last month's webinar more about risk, but obviously the younger generation have time on their side to allow the investments to grow through various stages of growth. And in bad seasons, they have time to wait out the storm. As I mentioned, we discussed this in last month's webinar. So before we kick off, I just start off some bad news again and ask you the question: why do South Africans have such poor savings culture? It was interesting to note that a recent report revealed that South Africa's savings rate sits at only 0.5% and is below that of most emerging market peers. Now, if you look at what's happening in the States, they have a savings rate of 12.4%. The Eurozone has 11%, and South Korea has 13.7%. So the countries even further behind its emerging market peers, being Brazil, India, etc. They have 16.9% and 10.8% respectively. Okay, so we're way behind it. So the national savings rate measures the income from households, businesses, and governments. Okay, as I say, the savings. So it is a GDP, a gross domestic product, that is saved rather than spent in the economy. So as I mentioned just now, South Africans consumers do not have a buffer, and that's what it's all about. A savings is a buffer in a form of savings that they can dip into during periods of high inflation and recession or recessionary fears, and that's what's happening right now. We don't have a buffer in our high inflation scenario right now. So in short, South Africans cannot maintain their lifestyles without dipping into or taking on more debt, and that's what's happening also. A lot more people taking on debt. So that's quite scary. Well, equally concerning was another report that stated that 90% of South African retirees cannot maintain the same living standard try to go into retirement. Okay, so people obviously have to work longer and things like that. This means that they must, as I say, they need to work longer even after retirement. It's also a fact that South Africans' life expectancy is also slowly increasing or steadily improving as such. So saving or planning and saving becomes even more important as people live longer now. So 76% of South Africans regularly run out of money before the end of the month, and more than half run out halfway through the month. That's very scary. So obviously there are many contributing factors to South Africans' struggle to save and make money last. It's been found that the single most important driver of low savings in this country was slow income growth and a decline in income per capita. So while these two factors are largely affected by external conditions, there's still hope. And I like it, there's still hope for consumers to put their money back into their hands and make it stretch. How do you do that? The best way to do that is to take what little income you might have and strike a balance between saving and investing. Okay, so why should you save and invest? Okay, saving, as I mentioned just now, is obviously both important components of a healthy financial plan. I mentioned just now again, savings provides that safety net and a way to achieve those short-term goals. Okay, well as obviously with the investing is obviously more than the longer-term goals. We can also go get the longer-term growth or returns as such. But put it safely, to put it again, and I want to highlight again the differences, is it all comes down to risk. So your appetite for risk, investing also, it comes down to risk of losing money. And I'll touch on that and obviously a bit later. But the key difference also between saving and investing is that one action stores your money while the other grows it. So in this webinar, we want to focus on the method that grows our money, which is investing. So substantial growth is how we create passive income and also, first of all, create wealth and then build on that wealth that will sustain us later in life. So we can't just achieve growth through a basic savings account. Whether it's saving or investing, it isn't a question though. It is, I mentioned just now, it is important. It's how you save and invest that matters. Okay, so there are some differences between saving and investing. I'm not going to go into all this. You can, when you get the presentation, the PDF, you can go into more detail. But the main thing, obviously, there are differences. The main thing with a savings thing is that it's used for, you're putting a part of your income away, saving towards something, as I say, usually be an emergency fund first of all, but also saving towards buying a certain thing. That's the prudent way of doing it instead of using credit. Whereas investing is just building up a capital asset and obviously hoping that will grow over the long term. So again, the time horizon is very important. Typically, a savings will be anything less than 3 years, and investing will be more than 3 years. That's one way of looking at it. Saving is what's important, especially when it comes to emergency fund. You want to be able to access your funds very quickly, so you need highly liquid funds. Whereas investments are not as easily liquid. It will take a few days to get your money out. And obviously, I mentioned just now, the risk with savings is low or negligible. With investing, it's obviously slightly higher. Okay, so I don't want to go into too much detail here. So if you had to break it down further, what is saving? What's the benefits of saving? And again, I want to highlight for you the safety net, what's important for those unexpected events. We talk about saving. Your first investment or your first savings thing would always be a emergency fund. And we've spoken about this on many webinars in the past. You need to save between 3 and 6 months expenses, living expenses. What's important, obviously, having liquidity, gaining access to those funds. So, you know, a lot of people might have a separate savings account linked to their normal current account. I've even considered using a separate credit card or just having a credit card just for emergency funds. So putting money into the credit card. That's one way of looking at it. And obviously putting additional funds into other shorter term investments. We'll discuss it a bit later. So the main thing, it's generally low risk. Your money is safe, just understand also that your interest rates that you're receiving are also very low. So the main drawback here is that you could be missing out on potential higher returns. And obviously, you must also understand that if your money, your short-term money or money is being invested in a savings account, must be beating inflation, or you'll be going backwards. Okay, so what is investing? This is where you obviously can just grow your money over time, putting it to work. You have potential higher returns. It's mainly using compounding. That's number one, and obviously reinvesting any income you're getting it from your investments, be it interest or from dividends, and reinvesting it and get your money to work harder for you. So it's just taking on more risk, as I say, the potential higher returns over the long term. Okay. So the main thing I want to highlight here, okay, because investing involves taking on some risk, it's essential to choose investments that align with your goals, your investment objectives, your goals. Number one, and number two, your risk tolerance, okay, and number three, obviously your time horizon. And we'll be touching on it a bit later in more detail, okay. But in general, the longer you can invest, the more risk you can take on. Okay, because you have more time to ride out the ups and downs in the market. Okay, yes, the markets are volatile. There's a lot of uncertainty in the markets right now, but it's better to be in the market than out of the market and waiting for things to recover. Okay, so it's not time in the market. It's not timing the market. It's time in the market. There's another cliche that we always talk about. So when it comes, so let me just grab some water here quickly. What is better? Which is better, saving or investing? Saving is great, but it's not enough on its own. Okay, if you want to grow your wealth and reach your financial freedom, you need to invest. Okay, so let's talk about it. What are some of the best savings and investment vehicles? So savings products would include a standard savings account, or a call account, money market accounts. You'll see on the next slide, I've done some research on that. I'm amazed how many people are always phoning us and looking for the best rates. They're shopping around. So many savings account will be offered by most banks. It's a safe place to hold your money. As I say, it's for short term. Regular savings account typically offer very little in terms of interest, around about 8% at the moment, but it's obviously less than 10%. So it fluctuates from bank to bank. And obviously this is all dependent on what's happening with the repo rate and prime interest rates and things like that, and that's all determined by South Africa's Reserve Bank. But the main thing I want to highlight here, and I want to advise investors, do not store too much of your money in savings account for too long. Okay, so yes, our emergency fund is to have access to liquidity, but you don't want to put millions in there. Okay, so remember, it's 3 to 6 months living expenses. Remember, the main thing here is inflation. That wolf that knocks at the door, it eats up what you call purchasing power of your money. So yes, it might be safe, but remember, you might be losing money day by day. So here's a quick table, best savings vehicles. I went to a website called Rate Compare. It's an interesting website here in South Africa, and then obviously you have different savings vehicles. A basic savings account is called a call account. ASISA cash invest tracker is offering you the most, or the best interest rate there at the moment, 8.9%. They do have a minimum balance. Obviously, you can shop around. There's 50,000, but the main thing is you have access to that money straight away. Okay, so if you've built up enough income, it's one way of looking at it. If you want to gain access to it straight away. Going a bit longer term, 32-day notes account, SASFIN, is offering the best returns there, best normal interest rates. You can see there from 8.75 for a 32-day call account. Fixed deposit, it was interesting to see that Time Bank is offering the best returns there. Over 1 year, not returns, interest rates, 10.48%. What's interesting, you can have that account with a minimum balance of R1. Okay, so they don't have minimums. SASFIN, as you can see there, 20,000 Rand at least. So that's a nice way to start. You want to have access to your money, maybe look at Time Bank also. Okay, then money market deposits. That was interesting also where I was doing all those exercises. They're not the easiest information to find. But Standard Bank, for example, is offering 8.7%. You have access to the funds straight away. But there you can see minimum is 100,000. I didn't look at all the other banks, but I can gauge that they're around to be about the same, 8.7%. Okay, so the main thing I want to highlight here between a money market deposit account and a money market fund account, a unit trust account. So the main thing with this whole slide and the savings vehicle, remember, it's a good idea to keep some money aside for difficult times in liquid investments. Okay, it's a double-edged sword, however, because the more liquid your money, the less is earning an interest. Okay, so money market unit trust funds is not the same as a money market account. Okay, while often mistaken for one for another, there are two different types of financial products. Money market account is a particular type of interest-bearing savings account. Okay, it's usually offered by a bank, like you see in this example here, Standard Bank. And the money market accounts tend to be insured by what they call CODI. And it was quite interesting to know that when I say CODI, is C-O-D-I, and that stands for this thing that the Reserve Bank brought in a few, well, recently. It's a subsidiary. It's called a Corporation for Deposit Insurance. So you're covered up to 100,000 Rand as a depositor. Your money in the banks. If there's a run on the banks, and obviously it's just the main thing is to protect the vulnerable depositors. Okay, but a money market unit trust account, it's an open-ended unit trust account that is invested in short-term securities. Now they pay out dividends to the investor. Okay, it's just suggested you don't have more than 5% of your funds or your money in a particular money market fund, because there are some risks. Okay, they're not risk-free. Obviously there's risks involved, but the main thing here is that they maintain a stable value for each share. Okay, so they offer higher rates as well as higher balances than most savings account. Okay, so money market, I did a whole thing with we got a tool called Funds A to Z, and I filtered it out to find out which is the best money market fund over the last 12 months, and Momentum International Income Fund came out with 12.14%. So remember, the whole thing is it's safe in the sense, but you can also get your money out within 5 days. So investment products, there's a whole range. Obviously shares, bonds, or interest-bearing securities, unit trusts, exchange-traded funds, property, etc. They all come with different levels of risk. So we talk about bonds, obviously, or interest-bearing securities. They're the least risky. They're typically guaranteed by the government, but also offers the lowest return. Individual shares, on the other hand, or having exposure to the share market or to equities, are the riskiest, but also, as again, offer the highest return. So what's interesting now, when you look at unit trusts, I try to put everything to one slide here. When you're choosing a unit trust fund, there's different tiers to look at. So tier 1 is geographic area, South Africa. So yeah, we have at least 60% of your assets. This is a unit trust fund. 60% of your assets must be in South Africa. Where a worldwide fund, it will be both South Africa and international, where global will be at least 80% offshore, and then regional will be at least 80% exposure to specific country, for example, the USA. Okay, so it's geographic region. And within those different geographic regions, then we can break it down into tier 2, which is the asset type. So we look at equity, multi-asset, real estate, and interest-bearing. Those are the main ones there. And then from there, you can break it down further to more details with the tier categories. So it's one way of looking at, when you start looking at where you want to invest, is to look at this slide. I also did, when I said I did a scan, I used this little tool here called Funds A to Z, and they've got a mega fund sheet, spits out a little Excel spreadsheet, and I just took the top 20 funds, and it's all based on the 12-month performance. And you can see, obviously, number one, the Old Mutual Gold Fund, okay, gave you 61% over the last 12 months. Okay, not too shabby. It was interesting that that PSG Global Equity Feeder Fund, it's a global fund, gave you 29%. So nearly 30% difference there. But the whole idea is, imagine if you had a portfolio of these different stocks, and if you add them up and your average of the market was about 10%, you're doing pretty well. Okay, so obviously 10% plus is what you want to be doing. So I suggest that again, look at these funds. You go look at in this Excel spreadsheet, there'll be links to the funds A to Z fund fact sheets. Okay. So what are investment vehicles to look for, which are suitable? So again, what I've done here is looked at all our different offerings that we offer, PSG. We've got a voluntary investment plan. This is your basic unit trust account for someone who wants growth, income, flexibility, and access. There's no restrictions on who's it not suitable for. There are, you can see right across all our investments. Let's get this look good. Spotlight here, you can see lump sum is 20,000 right through minimum 500 rand debit order, etc. Okay. Investment options, there's a whole range, especially with the unit trust, over 450 funds to choose from. With the tax considerations, obviously, there is tax payable in income and dividend distributions. There's also CGT, capital gains tax, may also be payable when you sell or switch. But the main thing here, the main advantage here, you have access to the funds, you have flexibility. Okay, so it's an investment vehicle for you to start building and creating wealth. Okay, you can have access to your money anytime. There's no fixed term. Okay. Then another savings vehicle, what I like a lot, is an endowment. This is more a tax-efficient vehicle. It's for people that are paying more than 30% income tax or on the marginal tax rate. It's also for someone that wants more estate planning. You want to set up beneficiaries and things like that. It's also for someone who wants a disciplined approach to saving. So yeah, remember, you've got easy access to your funds. Yeah, it's not so easy. Yes, you can take money out, you can take a loan against it, but there's an initial restriction period of 5 years. So this is a nice little vehicle for you to start saving, especially if you're looking at 5-year blocks. Yeah, and we have the tax-free plan we've spoken about before. There are also some limitations here in the sense that there's only funds, the clean class funds available. So instead of looking at 450 funds, you have about 95 funds you can choose from. But the main benefit here is that all growth, capital growth, income tax, income from interest and dividends is all tax-free. Okay. So the thing is, there are limitations. Yes, you can have access to the funds. I can take the money out, but you just can't put it back in again because you can't increase your contribution limits. Remember, you got 36,000 a year, 3,000 a month, but also you get a lifetime limit of 500,000. So there's pros and cons. There's pros and cons of all these investments. So it's important to do your homework. And then we have spoken about this also a lot of times, retirement annuity. This is the best vehicle for you to start saving for retirement, gives you that flexibility. This is over and above if you have a pension fund or provident fund through your company. If you're self-employed or in sales, you need a retirement annuity. The main thing here is that your contributions are tax deductible up to 27.5% of your taxable income, obviously limited to 350,000. Access to it, again, this is also very similar to this here, disciplined savings. Anyway, you get access to those funds before your age of 55. If you officially immigrate, you've got ill health and disability, obviously terms and criteria apply. If the fund's only less than 15,000, but you can retire anytime after reaching the age of 55. The whole idea of your retirement annuity is to provide for your retirement. So you can take a lump sum out as a lump sum, and that'll be obviously taxable. But also the other 2/3 has to be invested into what we call a living annuity, and that's going to provide you monthly income. Okay, so that's just very quickly to give you a overall. And then we've got more advanced, I call this advanced investment vehicles. We can talk about a local share portfolio. You can also go offshore. Who's suitable for someone who wants to build a share portfolio, having access to obviously JSE listed shares and exchange traded products. That's the exchange traded funds and exchange traded notes. So it's not for someone that does not like volatile markets, and also someone that wants capital protection. If you want to build a share portfolio, rather look at something like a unit trust account. It's going to be more diverse. Okay. There's no minimum investment, but you should be aware of the impact of the trading costs on your investment. I suggest my recommendation is that if you start at least 25,000. Okay, so you have exposure to again ordinary shares, preference shares, exchange traded funds, exchange trade notes. If you only got 25,000 funds, I suggest 25,000 rand is, and you consider adding to those funds, then it's fine. And I suggest maybe look at the ETF portfolio and then add on to it later. There are tax implications here. Same with offshore. You can buy and sell shares within the JSE trading hours. You can withdraw the funds after settlement, which is 2 + 3, 3 days, 3 business days, and another 2 days to your account. So 5 days, you have access to your cash. Okay. With offshore, again, it's not for everybody. So the 25,000 is also not for everybody. With an offshore portfolio, we recommend, okay, minimum 1.2 million to build a diversified portfolio. Okay, there's 1,700 global stocks you can choose from. Do you know there's over 38,000 stocks? Our list is about 1,700. Obviously, all the main stocks on the S&P 500, the NASDAQ, the FTSE, etc. You also have access to ETFs, not available here in South Africa. Remember, the whole idea about going offshore is diversifying your portfolio, diversifying your investments geographically. That's number one. And number two, having exposure to shares or sectors not available in South Africa. Okay, so that's a big advantage there. And then for those of you that are looking at more shorter term trading, you consider you got some money to invest or some money to trade rather, I suggest maybe CFDs as a way of looking at it. Again, it's not for everybody. Okay, it's a suggestion. We only trade the top 100 companies. You do need a minimum of 3,750 rand, what we call initial deposit. I suggest minimum at least 10,000 rand. Remember, the minimum trading or the minimum transaction exposure is 25,000 rand. So 50% on the top 40 will give you 3,750 rand. If you're trading the next, what we call mid-cap stocks, the next 41 to 100 stocks, the margin required there is 17.5% of that, of 25,000 is 4,375 rand. Again, you need additional funds for what we call variation margin. So again, this is not for everybody. CFDs, single stock futures, I believe give you a bigger bang for your buck. It's around about 15% exposure. You can trade the top 100 stocks, their Satrix. You can also trade the index futures. Again, this is more for the day traders, and yeah, it's a bit more volatile, more risky. So just move on quickly. We're running out of time. So let's move back here. Cool. Okay, so how do you start investing? So the earlier you start, the better. And obviously investing regularly. Now, there's an example of someone that's starting young, age of 20, investing 500 rand a month. If your goal is to get to 10 million rand, okay, the earlier you start, the better. And obviously this is increasing it every year by 6%. It will escalate by the age of 45, yeah. 20 years later, you're grown. Sorry, age of 65, it takes you 40 years to get there. You'll go to your 10 million. So I just wanted to put this slide in just to show you, just starting small, doesn't matter. You can start as little as 500 rand and then building up from there. Okay. So 5 steps to successful investing. We have touched on also before in previous webinars. I'm not going into too much details here. But the main thing here I want to highlight for you again, understand what is your risk tolerance. Are you conservative, moderate, or aggressive? I always find it fascinating that people are young, and we discussed this in last month's webinar. They're young, okay, but their risk tolerance is very conservative. So they invest in money market accounts inside a tax-free investment plan. No, that's crazy. Because remember, up to the age of 65, you've got a taxes, you got interest exemption. So to me, it's crazy to put your money into a tax-free and investing into a money market or an income fund. Rather use a VIP for that. Yeah? Because within a tax-free, you got tax-free income already from, or your income from interest in that is tax-free already. So yeah, diversify your investment. That's one of the best ways to handle inflation, handle a risk, is to have a diversified portfolio. And also important is to have asset allocation. Yeah, how much of your money is allocated to cash? How much of your investment is, or your funds is allocated to money market or savings account, property? We're not talking about property, it can be physical property, but also when I say physical property, it's rental property. But also things like listed property. How much of your money is exposed to the equity market? The younger you are, they should be more involved in equities. I'm a firm believer in a balanced fund and building up investments around it. It's important to access your investment performance at least monthly. Look at your portfolio at least monthly, and then at least once a year, rebalance your investment portfolio based on that asset allocation. So as I said, I'm not going to go into too much detail here. Please go look at our YouTube channel and refer to the previous webinars. Okay. So how do you start saving and investing? Very easy. You register online and choose a unit trust for your investment. Okay. So if you're a new client, obviously you need to send out your FICA documents. But once you got that account open, all you do is you log in and submit your investment instruction, be it a lump sum or recurring premiums. That's number one, and then select the underlying investments. That's how easy it is. Okay. So in summary, what's important here is that take what low income you might have and strike a balance between investing and saving. Both are important to a healthy financial plan. There's a place for each. Yeah. So I don't go into too much detail here. Just repeating again what I've spoken about before. So in conclusion, I hope I've provided some value. I really appreciate if you can pass on the recording when it comes out in a day or so, as well as the PA, especially to the younger generation, to let them understand a bit more about investing and saving. So that's number one. And number two, obviously, as I said, refer to our previous webinars. There's a wealth of information there. Okay, so I really appreciate your time and your interest. What kind of questions do we have? Let me see here. Okay. Cool. Paul says thanks. Cool. Okay, here's a question from Sandile. Okay, what is better, a lump sum or monthly debit order? Okay, good question, Sandile. I always get this question. Well, I always think people should ask this question more often. I believe it should be both, lump sum and investment. In other words, ad hoc payments. So if you're starting with a lump sum, great, put in the 20,000 Rand, but then also add 500 Rand a month. Okay, that's the best way of looking at it. But if you are looking at lump sum, I suggest, the biggest challenge with lump sum investment, you might be investing at the top of the market. I see that a lot of times, and then obviously the market pulls back a bit. You might have put in 250,000, and now you're down to 230,000. You lost 20,000 because of the market movements. So one way of getting around that is what we use a facility they call a phase in. You can phase in the money every week or every 2 weeks, or monthly, whatever the case might be. That's, I believe, a much better way of looking at it. If you're just starting out, monthly is obviously the best. That's recurring contribution. Do it regularly, do it consistently, have a debit order set up. You think about it. So the main thing about a monthly investment is the advantage there. You're taking advantage of rand cost averaging. Again, we have spoke about this in previous webinars. Okay, so Sandile, I hope it answers your question. Tracy wants to know, I'm a complete novice. I'm interested in trading shares. You mentioned CFDs and single stock futures. Is that a good starting point? The first question, Tracy, I'll ask is what is your risk tolerance? Obviously, trading is more for aggressive traders, someone who's willing to lose all their money or some of their money. So it all comes down to, it's not about making money with trading, it's about avoiding losses. So it's position sizing and things like stop loss. Ideally, it's 100,000 Rand. You're going to start trading to make it worthwhile. Position sizing, we're talking about using 2% of your capital. So 2% of 100,000 is 2,000 Rand. That's the most you should ever lose on a trade. That's number one. It tells you how many shares to buy. And then from stop loss is very important, and you adhere to your stop loss. So with CFDs, I mentioned just now, the minimum I suggest is at least 10,000 Rand initial margin. You can maybe have one contract open. With CFD, single stocks, you might have a few more because it's all rand based. But the main thing when it comes to trading, Tracy, you need to become an educated speculator. I believe, I always look at this and I think, wow, most people trading CFDs and single stocks are more gamblers than traders. Here's a question here from Vessel. Yeah, you're right, Vessel. It's we are still planning that seminar. It's from Sorrel, seminar on CFDs and derivative trading. I believe that Sorrel must probably be highlighting it sometime. Please go back to slide 21 to view the content. Okay, Liesel, let me just go back quickly. I was too quick for you. 21. Whoops. Content. Okay. Yeah, it's just a quick summary. That's all it is. Everything I've spoken about in this presentation. But as I say, you'll be getting the PDF of this. You can go through it in your own time. Okay. So guys, from my side, thank you very much for being on this webinar. I don't want to take up too much time. Again, as we always say, these webinars, it's for education purposes only. So here's my little disclaimer. It's for content for education purposes only. I'm not soliciting any investments, but also any questions you might have, you can drop me an email at wealth@psg.co.za. You can also get me on one stream line there, 0860 000 368. But all these products we spoke about, there's a link to what we call the PDF of the different investment vehicles, the voluntary investment plan. So it opens up what we call the key information document. Understand what you're investing into, okay? And then also when you're doing your research, don't be in a rush. I'm amazed how people always want to make money, but they don't do their homework, okay? So guys, from our side, thank you very much for being on this webinar. Until next month, bye for now.